All right, good afternoon, everybody. This is event trader Gavin McGuire, and I am being joined by chart trader Brett Manning. Brett, how are you doing today?
Yo, pretty good.
Hey, another crazy day in the markets. I mean, basically, the last time we met would have been on February 19th for this segment. And a lot of times over the last few weeks, we've been saying not a lot has changed, but that is certainly not the case. We were just a day shy of the all-time highs in the S&P futures at that point. Since then, we've given up about 10% of those gains. Some pretty volatile action today, so let's break right into it. Now, let's just kind of take first a quick look at today's action, Brett. What are your general thoughts on what we're seeing here?
Well, I mean, just more wide swinging volatility, a little more of a kind of headline feel to things, which is really what was so just wonderful about the
Yeah.
rest of this week is so much of the volatility has been it's been so long since we have seen true volatility that isn't just simply a reaction to some kind of political headline, 5 minutes earlier. Like a lot of the volatility we've seen over the last year, going back to say really, late December 2018 was another really terrific period for volatility trading. But a lot of the volatility we saw last year, again, September is a good example, where it was really just the VIX was up, but there wasn't free, wide swinging, loose price action. There was just nothing, 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 and then a Trump tweet, and then the market, rattles around for 10 minutes. And then, we're sitting there again. And that is really difficult to trade. But this has been just spectacular for if you like trading highly volatile markets, which I obviously really do. So this has been really great because it hasn't taken immediate headlines. It's been just, the inside market. The bots have left it. It's a poker game. There's big poker playing folks making bets, and the crowd is being swung around 1 second behind, getting cornered into lots of different conundrums in terms of where their money is, where their stops are, where their bets are, and where the sweat is. And you just need to understand how to read that. And it's really, really terrific if that's your game. So it's been really great. But, today I think we've got to the point where it's a little bit more kind of like we're settling it into an area where I think that it's interesting to see that the headlines out of California have been a little bit jarring to the market because, at some point, and first let me just say a quick disclaimer. So I'm not a medical expert. My wife is a neuroscience PhD. I got that going for me, and I'm a casual fan of epidemiology. I think it's an interesting science, but I'm not an expert, and none of the views that I'll say during this have anything to do with the views of anybody associated with Briefing.com or Briefing.com itself. It's just me solely, and I'm not an expert. But what I see and what I've read suggests that we should expect that, a month from now, there's going to be 25 or 30 or 50,000 cases in the United States. That's just should be a bare minimum expectation, maybe more. Like it's going to blow up in geometric curve style, and the cat's well out of the bag, and the idea that we're going to contain it is just a joke. So that's where my mindset is, and I think that the market will eventually start to understand that's where the mindset is. And at that point, hearing that there's 10 new cases in Washington or something like that is not going to be a market-moving headline at all. So I'm actually a little surprised that the California headlines seemed to rattle things around a little bit. I know we probably got some algos hooked up to those, but we're going to get to the point where those are not, I think, meaningful headlines. And then we've got a kilo we put in. We finally got the put call up well over 1.35 this morning, and we even had it hang out up there, during the entire bounce that we saw this morning, which is a sign that, without some big headlines that are seriously impactful, it's tough for this market to kind of organically make its way back down to test that low, I think, for the rest of the day. So I'm looking mostly long side, but again, you're going to get pot shot by some of these headlines. I think that with the Microsoft setup, that's a bit what happened. But, it also was, I think, falsified technically. So it's probabilistic. But I think that, letting things come to you, generally speaking, the mantra that I put in my notes this morning, if you like volatility trading, it's really important. 4 days into this kind of process where we've had just massive gains, it's really important to remember that it's not that easy. And the second you start to feel like it's that easy, you're going to give it all back. And so really reset yourself and say, be picky. Let the easy setups come to me. And let the money happen to you rather than going out and trying to get it. You'll see it. That's what's been happening over the last few days. Is it's just been, I think, very naturally apparent setups that are easy to get because the volatility has been so wide, and you get big follow through on the pattern, so you get these huge gains relatively easily as long as you don't try to force it. And I think it's just really important to get back into that mindset now at this point to make sure that we don't start to go through a series of, where you start over trading when this gets a bit choppy. But otherwise, I think we're in some kind of swinging range bounce kind of process, and we will eventually make a lower low than we saw this morning, where I think we'll see some more dramatic, larger time frame sentiment extremes. And I would see it as very unlikely that we would possibly escape this without flushing under 3,000 in the S&P and probably, tagging somewhere in that 2950 area. So we've got work to do, but I think that it's going to be tough to do it right now.
Yeah, and certainly we've seen plenty of attempts to push markets around with headlines. We were talking earlier today, got right around that 3,000 psych level. I got in a little bit earlier on that bounce, unfortunately, but we had that big, massive snapback, and then got back on, was noting those overnight session highs right around 3,100. And sure enough, that's where we kind of ran out of steam on this rally after nearly 100 points. And that's when he started seeing all those headlines start coming across. I know one of the Washington headlines that Scalp had posted, he had thrown on the disclaimer that it had been the story had been 9 hours old, but you're starting to see a lot more of that and a lot more of this coronavirus kind of hitting home. So I think I saw 8,400 people were under investigation or something like that in California, Brett?
And 28 new cases.
Yeah, and 28 new cases.
And as of last night, Trump's press conference, I think there were 14. So now we've tripled it.
Right.
Because we looked at people. Because there's lots more out there.
Right. Exactly. And
because there's thousands of cases, and it's gone. It won.
Yeah.
Give up containment.
Well, and I mean, it's interesting to kind of take a look at it too, because I'd be curious to see how people are figuring out that these are coronavirus people or if it's just the everyday flu, and what the breakdown is of that. Because I did see a few of the original headlines. For instance, there was 6 people in Westchester County that were being under investigation, and I know the first 5 came back as not having anything. So I'll be curious to see how this kind of pans out, because right now, at the time earlier in the day, there was 78,000 cases in China. There was only 4,000 outside of China, and 65,000 of those 78,000 cases in China were in the Hubei province, which certainly gave the idea that this was a little bit more tightly contained. But now we're starting to see these numbers really ramp up higher in other areas. But I'd still be curious to see how much of this is going to play out as coronavirus and how much of this is just kind of a little bit of a panic mode set off by the CDC.
I think that what you're seeing in those numbers don't in any way reflect reality. I think that we need to be given numbers, but there's statistical models that I think are far more reliable than people trying to count, especially in rural China. And we understand how these processes work. There's well-defined mathematical models for this kind of thing. We know what the factor is for every one person, how many people are going to get it around them, especially if it can incubate for like 14 days, and there's some theory that in some cases this can spread before there's any symptoms. There's also a really important point here. If we're just talking about the virus itself and the latest data from the smartest people, if you think about the fraction, to understand the mortality rate, it's just a fraction, right? It's the number of people who've died from it, divided into the number of people who we've identified as having it. And we know what the range is with a coronavirus in general, and with this one in particular, that there can be lots and lots of cases. There was a New York Times piece that came out this morning, from a doctor in Hong Kong who said there are lots of cases where somebody just gets a sore throat for a couple days and then they're fine. And that's coronavirus. And if you imagine that, those people probably aren't counted by anybody. So there's sort of like a dark matter here. There's the number of people we know are the cases, the whatever 85,000, whatever. There could be, even hundreds of thousands of cases that we don't know about. And when you figure that into understanding mortality rate, outside of Hubei province in China, the mortality rate is 0.4% now. And if you figure in this dark matter component, it could be much, much, much lower than that. So we're talking about something where, it's not remotely deadly to the average person. And there's lots of unreported cases. And those people don't ever know they have it. It's not like the people know and they're hiding it from the doctors. They never know that they had coronavirus. And they've gone around kissing their kids and their spouse and showing up at happy hour and riding the subway, and the cat's out of the bag. There's no way, given how contagious and how communicable this is, that that's not just gone like wildfire at this point. So what we know about the data is probably just an obscene underestimation of the actual scope of where it's already spread. But that's okay, because once you give up that game of containment and you start to move toward management and a vaccine down the road, it's really that the dangerous thing now, and the way that I put it to my wife earlier today is the meme is greater than the molecule. The damage that's being done by the coronavirus meme, that's gone viral too, much more so.
Amplified by social media, obviously, too.
And the media, you can get so much advertising space. If you write an article right now that says, read this or you'll die from coronavirus, you can sell a lot of ad space on that webpage. So there's just so much of that going on. So the meme is much more virulent and much more damaging than the molecule of COVID-19. The meme is really the virus here that we need to worry about. And I think that has the damage that's doing, and the fact that it's gone loose as a virus in the attention economy, and has run rampant and is what everybody's looking for and needs information about right now. The fact of that is forcing policymakers and authorities who are ultimately politicians to need to present the idea that they're working hard to protect people from this thing. And that's essentially, I think, putting policymakers in a position where they're almost forced to continue a containment game, and the containment game is the thing that's damaging the stock market. It's not the virus; it's the fear of the virus and the steps that are looming in front of us, like the potential possibility of quarantining whole cities in the United States 3-4 weeks from now. Like this virus is pricing in that, and that's possibly something that could induce a recession, and that has consequences of its own. So I would make the case, and I've made the case several times, that the bull case here is if we manage to shift the narrative, we shift it to a situation where the goal is to message to people that we're not going to try to play a containment game. This is a very manageable thing. It's very low risk in terms of your actual health risk. Just wash your hands a lot. Don't cough on people, and don't unnecessarily grab doorknobs and railings and stuff. Whatever you would do if there's like a bad cold going around in your neighborhood. And we don't need to take steps to try to barricade off highways and trains and stuff. We don't need to move in that direction, because that's ultimately going to have much more damage than the virus is, and trying to contain the virus is probably futile anyways. So I think that if we shift to that kind of strategy, away from a containment strategy and toward a management strategy and a public service messaging strategy, I think would be really positive for the stock market at this point. But I'm not sure that the political landscape will allow for that at this point.
Yeah, it certainly doesn't seem that way. I mean, certainly the newspapers, like you said, they're trying to grab headlines, so a lot of sensationalism going out there. I was listening to a Crane Shares webinar earlier on the coronavirus, and Crane Shares is very heavily involved in China, so it's interesting to kind of hear their take on it and how they were really looking at the media as a culprit, just given all the attention that it's given, and this sensationalized headlines around deaths and everything along those lines. So it's like you said, trying to control that message is key, because you start taking a look at some of the Chinese data, and certainly some of it's been eye-opening if you're just looking at traffic reports and things of that nature. But we are starting to see those numbers come back. For instance, China's now back at 72% capacity, according to reports that Crane Shares was looking at. So we are seeing that come back, and I am curious to see, when you come in and see red, and then you're looking at what's green, and it was China and Hong Kong that were up earlier today, and the rest of the world actually hasn't pulled back nearly as much as the United States here. So there's definitely also the idea that perhaps the United States was just a little bit over its skis in terms of equity valuations that is being corrected a lot in these headlines, and certainly giving some cover for people to get out of those positions. I know, Brett, we talked a lot about some of the overlining in the extension to the upside and call buying, and how people were actually paying up for calls in a little bit of a FOMO trade, and we've seen that reverse. And we talked a lot last time we met about the pockets that could come into selling. Uh, you know, we were still early in on the coronavirus scare at that point. It wasn't really impacting the U.S. markets, at least to that extent. But we've definitely seen that play out and a flip a little bit more to the side of people looking to get in and buying those put protections to the downside.
Yeah, I mean, absolutely. We've seen some spiking. We haven't seen it go crazy yet on put call in terms of, I mean, the benchmark that I've looked at a lot is when you see the 10-day average of just the basic total CBOE put call ratio get up to 1.15 or higher has been an extremely reliable signal of a very near-term low and a panic. And I think that we are at 1.02 at this point on that average. So, and today's really the
I
first
got
day
the
that
put
we've seen
call.
it sitting
Oh, on the average. I'm sorry. Okay.
on the 10-day average. So
Right.
because today has been consistently around 1.35, which is kind of the panic mode on an intraday basis for me, that's pulling that average up. If we have 2 or 3 days sitting here, we will start to get that thing above 1.1. If we then make a lower low over the next week or two and we get it spiked up, we get a day where it's at 1.7, 1.8, you're going to see the average at 1.15 or higher. And that's been a time where I mean, obviously, all this is subject to evolution of world events. You know, if we start to shut down whole cities in the United States, then you can throw all theories into a cocked hat. But if we
Let me
can
ask you
manage to
Let
go
me
ahead.
ask you one thing on your 10-day theory here, because I would assume that the standard deviation on both sides is pretty wide on that average. Um,
Well, I mean,
does
I've
that
just
impact
noticed
your
you
read
can
on it?
you can look at the just paint the average. It's closing, so it's closing where it closes, and with the put call ratio, it's cumulative throughout the day. So the closing number is the number that reflects the entire day. It's not a price moving, right? So it can't dive at the close or something. It is a cumulative thing. So you have all the puts for the entire day and all the calls for the entire day, and the ratio between the two for the entire day. So the closing number is a very reliable encapsulation of that day. So when you look at the 10-day average, you're looking at all of the last 10 days, every single put and every single call. It's an entire average of all options activity for a 10-day period. And when that reaches 1.15, you can draw the line on a chart. It's great when it's above 1.25, but there seems to be I've posted the chart before actually. It's reliable. You put it next to the S&P, you see panics. It really is an oddly good kind of marker, a threshold for whatever reason, some kind of I don't know, pattern of human activity kind of thing or something. But it's a good kind of sense of when you get that number up above 1.15 or higher, you tend to be in an area where further very large downside moves are very, very difficult for the market to achieve because there's been enough total protection accumulated in the market where people don't need to sell shares anymore because they've bought so many puts.
Hey, Brett, we're going to have a nice little test here of your theory on the selling part. Just seeing a headline, New York State Health Department saying 700 people in the state have been asked to voluntarily self-isolate for 2 weeks due to the coronavirus. We got a bit of a tick down from 30:45 to 30:39. Was that a Scooby-Doo sound you just made?
Yes, because wait. Why would you ask people to do that? How do you identify those
Self-isolate.
people?
Yeah.
Well, but I mean that pool of people. What's not in the headline is because there are signs they have coronavirus. Why else
No,
would
it says
you?
due to
Oh,
coronavirus.
because they've got friends who have it, or what's the
Uh, I just see the headline. It's a tweet from
due to
Breaking
coronavirus? I understand
911.
that, but it could be due to the generalized threat of coronavirus, or due to the fact they all have the symptoms that are in line with coronavirus, or due to the fact that they've recently known people who went to Wuhan. There's a lot of different ways in which that headline could have meaning, so it's tough to really.
Yeah, it's
Either
tough to
way,
take
I
into
think all these things are going
context,
to
but
become. I think that we're getting to the point where it's just going to be like ho-hum, of course, because, again, if you're in a room full of 10 people right now, 5 of them are going to have this in a year. So there's no point in worrying about where the next 10 cases are.
Do you think? So, I mean, obviously, we continue to look for or lack of reaction, I guess would be the better term, for just some of these headlines. We're starting to see that a little bit, which I think could set off a little bit of a squeeze that we were talking about just earlier here. Maybe get us back to that 30-70 area would be an area where I could see us get into. Bulls could start getting the tape rolling in this final hour of trade. Do you think it's dependent on headlines discussing about a potential vaccine?
No,
Or do
I
you
would
think
take
it's
it.
um, just sheer running out of steam on these headlines to the downside while
I
all
don't.
the
I don't think
sellers are in?
I don't think there's any headlines that are good. So I think that what it would be is headlines that are bad and the market not being able to go down very much, and you see volume kicking up, you see a bearish setup that's unable to trigger, you see a lot of people packing into it. I think there's a lot of people that are starting to go through what I've gone through for the last 4 days. Look at the Dow short I had this morning. That looked, if you're just looking at a lot of different time frames, like, what are you doing shorting this? But in a really short time frame, it was really clear to me there was a pretty good chance we were at least going to bust that first low, where you got in, right? So there's a lot of people where you were at that point with stops under there, and the Dow is the week performing one, and I see this short time frame kind of action, the type of thing where people are propping it, somebody's trying to put a dam in front of the river, and ultimately you see size coming in that's probably size that just wants to get out, but it doesn't want to get out through the bid. So you've got big enough traders. I mean, they're going to be in there trying to pop the market up for 30 seconds so they can sell into the offer, try to squeeze some people out. So you see that kind of thing, rattling back and forth for 5 minutes, and it's inevitable that you're going to puke that order. You're going to puke that first low. You're going to dump it under. The question is, what do you get right after that? I don't know, but I know I'm going to be able to scalp quick, move my stop, and then it's free money if it goes. Then it went. Spectacular. There's a lot of other traders that have probably experienced that a number of times over the last 4 days. You get yourself into that free money situation, and it just starts rolling for you. You get 400, 500 points on something like that, and it's going to be really hard to lay off those moments. So if you get some headlines helping it, you get one of those moments, you're going to be in a situation where you're packing in a ton of weak-handed short-side money at this point because it's been a feast lately. It's the last couple of days. Once it broke loose, I mean, there's been so many moments that have just, they're feasting on these moments. And if there's a real bid that starts to show up and just sits there soaking it all in and it starts to go wrong, I think that's where your first really sharp rally is going to come in. We had a rally this morning that was off of, we just dumped so far off the open. We killed all the retail money that was calling their brokers this morning saying, I don't want to be in this market at all. And those brokers are managing that position off the bell. So that dumped. Once that supply left, we start to pop up through a vacuum a little bit because there's not this trailing offer. But if we get shorts coming in and trying to hit this again to just keep feasting on this, and there's a real bid that starts to show up under the surface, I think you're going to start to see you got a lot of fast money, weak-handed longs that have been sidelined, beaten up so badly for the last few days that they're just in this state where if the market starts to rally, they have to buy, because what else are they doing in life as a trader? They've lost so much money trying to buy this on the way down that it just becomes impossible if this market starts to jet. The initial reaction for people who've been beaten up on this is going to be to buy strength. And if you start that strength with a squeeze because you've got somebody who's willing to step in front of this and buy when all these shorts are trying to hit the bid, I think that type of dynamic is going to cause the first sharp rally that we see. And when you suck in a lot of that money, that's weak-handed long money, that's why I don't think you're going to get a sustained bounce off of this. Maybe we see the Dow back above 27,000, maybe an underside touch of the 200. Maybe we see the NQs get up to that, I think that 9,000 area looks pretty good. Maybe pop above it to hit the underside of the 50-day. S&P, I don't know, 3150, I don't know. But you get into a range, or maybe just above that tail from the top yesterday, where it's a wide range though, and you get this bounce and you set up that range. I don't think we're not going to V bottom off of this. I can't imagine. There's
Yeah,
it doesn't seem
I'd
likely.
agree
We got
with you.
enough retail money into the market at the end at the highs to, there's going to be that lid that comes. There's people who are way out of the money and they want to sell so badly on a bounce. And there's so much money probably sitting there like that right now that it's going to be tough to just jet through a V bottom.
I would agree with the V bottom or the U bottom scenario because I do think that we're going to have some kind of point where we see some of these earnings come in, see exactly what the impact is, and perhaps more importantly, see if this coronavirus pushes into a Q2 issue, which certainly appears to be at this point. I mean, we're only a month away from the end of the first quarter, and it's unlikely that this is going to completely wash itself out in the next 31 days or so. So I think a lot of people, because what's happening here too, Brett, of course, is that this is also a valuation issue now, where
Oh, yeah.
most people are looking for a 5 to 10% increase in earnings. We talked a lot about the easy comps that were going to be going in. That was such a key story for 2020. The other key story, of course, being the global recovery, and both of those are in serious question. And
Listen to this. If Microsoft falls 10% from here, a friend of mine just sent this to me. If Microsoft falls 10% from here, it will have a PE of 27.
Yeah, so still pretty frothy. And
Yeah, and you look at those forward earnings estimates going down for everybody. So there's yeah. I mean, if you think you're going to get a deep value bid, you're not. Question is this going to turn back into the bull market that it was, which is fueled by fiscal stimulus, monetary stimulus all over the world at the same time, and easy comps coming up? That's really about whether or not this is just if we manage to shift away from a containment narrative and we just get into this is a cold, people.
Yeah.
Why is this in the headlines all the time? This is ridiculous. Wash your hands. Like that we deal with risk. Imagine, here's a good thought experiment. Imagine if we put up a website that was quoted by everybody in the world, Bloomberg, CNN, New York Times, Fox, everybody, that was a running counter of the number of people who were dying in automobile-related accidents. Everywhere in the entire world, that number would just be running up like crazy. And I think the first thing that would happen is would just crash the auto stocks, right? And people would just stop wanting to drive because people they can't put in perspective global statistics on anything. But that's still the reality now. It's just hyper-awareness of that reality causes these micro-level changes in behavior, which is the thing that's the recession risk. And if we start having people in hazmat suits with police barricades out on highways and start putting in containment, strategies everywhere on a major infrastructure level, people are going to freak out. And it's just, you're going to get people just sitting in their houses, stocking up on food and sitting in their houses for 6 weeks. And that's not going to work out for the economy. So we just need to avoid that. We're not going to avoid the virus spreading. We just need to avoid the process of saying this is the strategy we're going to use to make people feel safe, is we're going to start, buttoning things up as if this is genuinely like, the plague of the 21st century.
Okay, we continue to see markets slipping lower here. We're coming in for a key test of that intraday 32 or that 30-30 area here, dipping just slightly below that. So we'll keep an eye on this action as we continue our discussion here.
So we should start going through some sentiment data.
Yeah, exactly. I did want to ask you real quick, though. We always try to avoid politics, but obviously being an election year, it's tough to completely go off of that. How much do you think is also involved with the rise of Bernie here, considering, Trump's biggest push is running on the economy? We certainly saw George H.W. Bush get tripped up by Bill Clinton in '92 because of the economy, and now that's factoring in here as well. Do you see that as a major play here, or do you think this is purely coronavirus that people are looking at?
So there may be some risk about who's going to be the Democratic nominee, but I think the idea that this hurts Trump is ridiculous. I think that this is probably, let's say we have a recession, unless you can show that it was just absurd mismanagement in terms of how they responded to the virus, people are just going to blame the pandemic. It will be the pandemic recession. And I don't think anybody's going to say that that's on the administration. So I think this is the one case in which a president could win re-election in a recession, simply because it will be the only recession that we've ever seen where it's so clear that the narrative will be about blaming something that no administration could possibly have stopped. So I don't, unless every other country in the world avoids recession and we don't. If there's some kind of way of statistically placing it like, hey, it must have been them.
Right.
I don't know, but I don't buy into the idea that this form of economic downturn is politically harmful for Trump in the election. As far as Bernie Sanders, I don't know. It looks like the odds are that he's going to be the nominee at this point. I wonder what South Carolina's going to do, because I've seen a lot
South Carolina's got Biden firmly ahead with Sanders
in the
third.
polls, but I've seen a lot of stuff. There's a grassroots movement right now to get the Republican, all registered Republican voters in the state of South Carolina to vote in the primaries for Bernie Sanders. So that's not going to be in the polls, and I want to see how that works out, because there's a big Facebook campaign going on. There are paid political ads saying, Republicans of South Carolina, we're calling on you to switch over in the primaries and vote for Bernie Sanders. So it tells you who Trump wants to be running against, and they can do that because there's no primary on the right. So they can all just go ahead and vote for Bernie Sanders. And I don't think that's taken into account in the polls. So it'd be interesting to see if that impacts the results. But if this becomes a nationally coordinated campaign, then there will be no stopping Bernie.
Right. Okay, so let's move over to the sentiment data here then, Brett. But let's start off with sentiment around the Fed. Now, the Fed's been pretty quiet on the issue. Certainly a couple of comments that Fed officials are watching it. But I think the most glaring items that we're seeing would be based around the Fed funds futures, which has certainly seen a marked pickup in what's expected in terms of actions from the Fed. Just taking a look at the March meeting, which will be March 18th, just about 3 weeks away. They are now pricing in a 63% chance of a Fed rate cut. And as you start working down the line, that goes up exponentially. Looking at it, 90% chance of one rate cut by the April 29th meeting. And then you start going out a little bit further, and you start seeing a 70% chance of 2 rate cuts by the June meeting, and it culminates in about 3 rate cuts. This would be the second year in a row, obviously, that the Fed would cut rates. Now, Powell has been very quiet so far about it. We saw the ECB's Christine Lagarde saying that they didn't have any sort of mandate yet for combating the coronavirus. So the ECB hasn't gotten on board just yet. Perhaps most surprising to me was the Bank of Korea last night, who was expected to cut rates 25 basis points, but they didn't move. So do you think, and again, obviously we're also seeing the 10-year yield at all-time lows here. Are you looking at the bond market signal as a key tell, or do you think people are maybe getting a little bit over their skis in terms of expecting the Fed to act? And if that is the case and the Fed doesn't act, do we also have the added issue of monetary policy impotence also kind of working its way into this market action?
I mean, I think that if you look at the front end of the curve, I would say I think 2-year yields are 40 basis points below the Fed funds right now, and that's a pretty good indicator that there's a market signal that there will be. I mean, generally speaking, the Fed likes to pretend that they're sitting in the driver's seat and holding the steering wheel. And if you look at history, it's really not the case. They tend to follow the market. And when you see the 2-year 40 basis points below the Fed funds rate, that's a pretty good sign they're going to be cutting. And I think that
quick question for you, Brett. We get the headline: Powell is concerned about the coronavirus, and the Fed's looking at it closely. We rip higher 50 points in the S&P off that. Are you shorting that?
Depends on lots of other things. I can't answer that question.
All right, fair enough.
How it looks, how it feels, what other headlines we've got, and all sorts of stuff, where we are in the pattern. I mean, all else equal, I think probably, yeah. But, because I don't think that the rate cuts are really going to do anything here. I think that they just need to align more with where market rates are. But bigger picture, if you look at the Fed funds, you go out to December, it says 3 rate cuts. I think that's just, we're dealing with percentage possibilities of a recession out of this, which I think at this point I think that at least a 1/4 negative growth rate is really likely. when all is said and done. I think we're going to stay with a containment strategy too long. I think that people are going to nest. I think that we're going to freak people out by the type of steps that we're going to take, because there's going to be this overzealous move by politicians, particularly in an election year, to look like they're being sensitive to how afraid people are of this situation, that we're going to put in place measures that are ultimately just going to foment panic and probably, have a bigger hit overall in a marginal sense on the economy. I would imagine it'd be tough to escape maybe negative growth next quarter. But is that really like that? That type of recession is a little different from a recession that is, because we have a massive bubble in, credit or something that's starting to unravel and deleverage. That's a different situation fundamentally. Both of them lead to a contraction in GDP, but the consequences for the next several years in terms of the economy are very, very different. This is something that's going to go away, because remember, it's the meme that's the problem, not the virus. The virus is not going away, but the fact that this is all you see in the headlines every day is going to go away. And people are just going to get used to this is another feature of life, and it's no big deal, and lots of people are going to get it, and very, very, very few of them are going to die from it. And, there's probably, there's lots of deaths from people falling off ladders. There's all sorts of stuff. If you look at the minutia of global data, you're going to find lots of dangers around every corner. And when people start to focus so much on one thing, it affects their behavior, and that's a temporary thing. And that's the thing that's hurting the economy. That's the thing that's hurting the stock market. So that's a temporary thing. I don't know how Fed funds are really going to impact things. There's a looming question as to whether or not there's a bigger dynamic here that's being masked by this coronavirus story, which is just that there's a bigger problem. There's, valuations are an issue, obviously, but they don't tend to matter until you're in a full bear market. Maybe there's a possibility that the corporate debt bubble is a little more precarious than we realize, and there's going to be follow-on consequences and dominoes off of something like this. I don't know. But I think that when you look at the December sense of there's going to be 3 cuts, that's really just saying, the Fed's going to react if we start to get, forecasts of negative growth. And that's really, of course they are. And it's not, it's not saying there's definitely going to be 3 cuts. It's just saying there's this little, normal curve expectation that's shifting down. And that's really, I think, being dragged there by where the 2-year yield is going.
Right. We're seeing a little bit of a pop back here as Mike Pence is making some comments trying to ease concerns around that coronavirus here, saying that
What's he saying?
That the threat remains low. So obviously
so that's wrong.
Yeah, that's going to be something that's obviously going to.
They really need to get past this.
Yeah, exactly.
Everybody's going to get it, but it's no big deal.
Well,
that's what the message needs to be.
Exactly, but I mean, you could argue that it's what he's trying to get to at a threat from a coronavirus, I suppose.
No,
but
say that. I
wouldn't be jumping in and buying this little pop here. That's for sure. I think people are going to come in and continue to lean on this. Could start at this point. It wouldn't surprise me to see a move back towards that 3,000 level going into the late afternoon, and then perhaps maybe a double bottom squeeze would be something we want to watch. But keeping an eye on this action while we talk here. So, Brett, some other sentiment trader items. Obviously, we did see a couple of areas that jumped into the excessive pessimism over the last couple of days. No surprises, some pretty wide swings in some of the daily indicators. One that we've been talking a lot about, and we talked a little bit about it earlier, and that's the high-low indicator. And that was, again, one of the things that we pointed out, noting that a quick downturn could happen because so much of the wealth was concentrated up in those 52-week high stocks. Obviously, we moved off the all-time highs in the markets, and a lot of these 52-week high lists have been decimated with some profit taking and moves back lower. I assume from this reading that that's basically what that's telling us, that this high-low ripped from excessive optimism to excessive pessimism because we probably lost so many of those 52-week highs in that ratio.
Yeah, I mean, the market's gone down a lot, and it's been an index move, and hedging comes in, hedging crushes everything, everything's in the index, so you're going to get, a lot fewer 52-week highs and a lot more 52-week lows.
And this is the lowest reading since October 2019, which is, of course, right before we started this ramp up. Another item that is no surprise to us here, Brett, as we know when volatility gets high, that SPY liquidity spikes. So we're seeing that at its highest level since August of 2019.
Yeah, and this just goes to show you, I think this is one of the most interesting short-term sort of vital signs kind of indicators in a panicky move is just you see people rushing to trade things that are super liquid. The SPY is a good example of that. You could do the QQQ liquidity premium or the futures liquidity premium. I'd stick with the SPY liquidity premium because it gives you a simple sense of, the ratio of trades going into the SPY ETF, in and out
Right.
money,
So nice and
and money
broad-based.
going in and out of the individual stocks that make up that index. It's moved to the thing that for sure. It's moving a lot now, so it's more interesting to trade. But also, if you buy it and there's a terrible headline, you will be able to get out no problem. And there's a lot of stocks where that isn't the case. You get much more slippage in a panicky situation. There's much less liquidity, so all the money starts to kind of network effect around the most liquid assets, which makes the disparity in liquidity even bigger. And it becomes a game where people are cornered into basically trading these big instruments. And there's a certain point when you get up to 0.75 or 1.0 on that ratio, you get to the point where you're at real extremes. We're already at a basic extreme, though, so we've already got signs of some form of the way that people behave in a panic. But you could actually just look at the chart and see that this is obviously a panic.
Right, and the third one being the inverse ETF, yet another vehicle. This hit its highest level since October of 2018.
And I think this is the new vanguard for hedging. I think it's one of the reasons why
Yeah.
we've seen some of the options data we've seen. Like, I think people are comfortable just buying, inverse, the QID, if they've owned a bunch of, technology stocks rather than necessarily buying puts on those stocks. So I think, when you get a market like this, I think the hedges are actually going more and more into inverse ETFs.
Right, and then on the excessive optimism, Brett, we talked a little bit about this, being that it was likely a little dated. A lot of this data was from the 21st, and really kind of got in before we saw the big market roll. But robo options spec and the AIM readings all were in that excessive optimism side. But I want to talk to you real quick about the robo and what a story that I sent you earlier in the week that I found to be pretty interesting. And we talked a lot about the lack of the retail investor in these markets due to a lack of stock splits that would make stocks a little bit lower, a little bit more attractive. But there was an article talking a lot about the excessive use of retailers using options trading in order to kind of, to be able to get into a stock at a cheaper level, obviously a lot more leveraged up. Do you think that a lot of this action could be a lot of those robo players just seeing those calls decimated and really getting hurt on a leveraged basis, leading to such a quick downturn in the move?
Some of it, for sure. I mean, we talked about this in the last couple of sentiment and flow shows. Were you seeing this skew in this? Because this is becoming, I think, small options traders, it's becoming a vehicle to be able to have leverage participation in stocks that are $2,000 a share. And I think that I think that you're exactly right. I think but that is just another version of the same thing. And the other thing I posted the other day is that if you look at the E-Trade and Ameritrade darts, did I send you that Bloomberg article that showed like a chart where they've just skyrocketed, over the last month or two? And so you're seeing just a massive amount more trading in the type of brokers that are generally used by retail market participants. Obviously, go ahead.
The one thing I would point out that would be interesting from that aspect is, that spike, I think we'd both agree, came due to a lot of the free trading that was starting to get laid out. But the options they still got to pay for.
Yes, right. So, but let's just pan back and just say, regardless of what caused people to start doing that, it is still the case that there is much more retail participation.
Agreed.
Particularly, and we know that retail market money is going to be alongside 95%. So when you're talking about this demographic in the market, you are generally speaking, it's a very safe assumption to say, we're not talking about, these are shorts and longs, even mix. This is people looking for which stock to buy. And so when you see that spike way up, then what you mean is, well, there's a big, regardless of what the cause is, there's a big new contingent in the market that is retail participation, buying a long exposure to various different instruments. And that is inescapably something that happened, regardless of its cause, into the highs. And so one of the first things that I did when I came in Tuesday, and I started shorting again, even though it looked very oversold after the big crashy move on Monday, was to say I think that we are in a situation where, but now that people have acclimated to this kind of process, there's a ton of people who are probably deep red who are in that retail group who are just going to be calling their brokers in the morning and saying, this hurts or whatever, or calling advisors or finding ways to, basically just turn as it starts to get too painful and dump. And the darts, the robo ratio, all these things kind of showed a sense that you want to be shorting oversold markets, because it's oversold markets that are orderly that cause panicky extensions. And I think that a large part of the reasoning to take that strategy is to see that, the precipitating conditions included, let's just say, less experienced non-professional money lined up long at a level we haven't seen in a long time in this market.
Right. Just anecdotally speaking on that, and something that you mentioned before, Brett, I'd gotten a call from a friend of mine who's a pretty savvy investor, and his comment was, I just had a buddy who just sold everything in his portfolio. He's like, what can I buy here? And that was right when we're getting around that 3,000 level. So you're certainly starting to see that play out to a little bit more of an extent, but we still haven't got that huge flush there. One other sentiment indicator that we saw a pretty big flip on, and that was the AAII bull bear indicator, which saw the bulls drop down 10 basis points to 30%, which was the lowest level that I could see since you got to go back to October 10th when we were only running at 20%. Now, we did have a bigger decline from January 23rd to the 30th when we fell from 45.6 to 31.98. Now, that corresponds directly with when China first, I think it was January 24th, when Xi Jinping announced the coronavirus was a pandemic in their country. So another big 10% drop off there. Obviously not a surprise. This would have been from February 20th to the February 27th point. All of it went to the bearish side, where we saw a big jump up to 39% on the bear side, which I have as the highest since, again, you got to go back to October 10th on that. So you taking away anything from these reads, or does that pretty much line up with what you'd expect to see?
So I think the AAII data did not hit an extreme on the upside and has not hit an extreme on the downside. So I think we're kind of in this middling territory where my general thesis with AAII is great, especially if you get the 4-week average in an extreme territory for a period of time, is a hugely important signal. We haven't seen that on either side in a long time, so I just kind of breeze past that data until we start to see it get more remarkable. And it really hasn't on either side, approaching the top or now. It's an interesting flip. If we're muddling along for the next month and we see it get to very, very deep bearish levels, and we start to see this, this shift from containment to management and messaging, there's going to be a really great long signal for a big snapback in the market. But I don't think that we've seen anything of, meaningful value from it right now.
All right, so just taking a look around. The last thing I guess I'd take a look at is the CNN Fear and Greed Index is now at 7, even though at the time the S&P was above the 200-day moving average. Do you follow this at all? That's
only to say that I think that it's the worst sentiment indicator that exists. So,
all right. Well, we don't.
I do, because it's. Well, let me just say, it's the epitome. It's the epitome of the thing that I kind of rail against. Like, it is just almost exclusively a collection of different things that just are the thing that's happening, rather than an additional insight into the thing that's happening. Like, of course, if the market is moving up a lot, that will mean that the indexes are well above their moving averages, and there's lots of different components of this, or like, there's lots of different components. It's like 7 different things or something. And if you look at them, most of them are just descriptions of an extreme move rather than, accompanying data showing you what's underneath the surface of that move. So I really like to avoid things like, sentiment is not equivalent to the relationship between, sentiment is not equivalent to price movement. And it's differentiating the two that gives you 100% of the insight. So just because the market's gone down a lot and bonds have gone up a lot, credit spreads are important, but there isn't a lot of, these are obviously kind of data mined elements in a descriptive process, and that's not completely without value, but of course, and I want to look for something that gives you extra value, where you find, generally speaking, with extreme changes in the way people are behaving in derivatives markets or in surveys or in various hedging instruments that kind of show where there's some kind of extreme misalignment and disproportionality.
All right. Well, I'll tell you what, Brett. That I think that'll do it for this show. There's one last thing that I wanted to ask you about, and I'm curious. Obviously, we got PMI data coming out over the weekend. China's numbers are due out on the 28th. Is there anything?
That'll be interesting.
Yeah. Is there anything in particular you're going to be looking at? I mean, obviously, coronavirus impacts and real curious to see how that China sentiment is over there. I think that's going to be arguably the most important data point for markets over the next 2 weeks. I suppose you could also argue Super Tuesday, but that's not necessarily a data point. Anything you'll be looking at in this round of PMI numbers?
So, no, I guess one thing that'd be kind of interesting is to see if we can correlate the notion of, where has it been most extreme in terms of containment strategies with where are we seeing the biggest dent to economic sentiment. I think that that correlation will be important because we're talking about gauging now, we're headed to the show here. We're headed to the U.S. And coronavirus has not been a story for the U.S., and now it's becoming a story for the U.S. And that's, it's moved finally to the big mecca of media. And, where I think the edge here is to know that this is going to become a vastly widespread phenomenon. We're going to start seeing, to me, and again, I'm not a medical expert. My opinions do not reflect those of briefing.com or anybody else, but I'm just telling you, here's what I believe, and that's the point, is that the edge is to say, well, that, a month or two from now, we're going to see, thousands and thousands and thousands of people with this, and we're going to see cases in, maybe every state. And that should be just kind of like a guiding premise to me. It is for me that that's what, statistical kind of epidemiology really suggests. And if you know that already, then if you know that the response to that is going to be massively harmful to the economy, then if you already know that's going to happen, then it's 2 and 2 to say we're going to see that economic harm. And then it's, kind of extrapolating from there. So if those changes are around the corner, if the money that's in this market hoping that this is going to stay at 15 cases in the United States is obviously going to go. And, there's going to be a broad-based impact. And I think that the bull case, again, is about whether or not we can shift to a strategy that says, this won't be that economically impactful if there's 50,000 cases in the United States over the next few months. Whatever it is that would mean that starts to give you confidence in the picture. And, instead, if we're saying we're going to quarantine Boston, or New York City or Chicago, and, when we start to see that kind of data, then that's going to be a big problem. And I can't imagine we'd escape some kind of real negative growth. And, then we'll see.
Yeah, no, it'll be interesting to watch it play out. Real quick, just keeping an eye on the markets here. We have given up those pence pop gains, as Brett and I had suggested. So, and as Brett suggested, he is not a doctor, but he plays one on audio, right? I guess that would be the saying that we want to get. And again, too, for people interested in the epidemiology charts, 3 weeks ago I posted that Robert Schiller report. And if anybody gets a chance, I highly recommend checking out Narrative Economics, his book, which has a whole index table of epidemiology reports, and you kind of uses that as a good basis for tracking narratives around economics. So it's a pretty interesting read, but definitely go back and check my post from, I think, what was around January 21 when I put that up. But Brett, wrapping this all up and concluding this here, do you want to go ahead and fire off on that?
Well, I mean, I want to go back to the thing that I think is most important right now in this situation. If you like trading this kind of environment, don't get cocky, because I've gone through this, back to when, I mean, I'd say the period, I started trading in the late 1990s, and, I did really well in 2001, 2002, but the period that really, I think, was defining for me was probably 2008 and 2009. And there's been a couple other periods that have been defining for me, but that changed my capital situation, that changed a lot. And I think whatever that is that, that kind of comes to have that feature in your trading career, then leaves an imprint, and it impacts the way that you behave. But I've had a lot of experiences in the past where I would have enormous success during a period like this, and then just become kind of acclimated to that kind of aggressiveness. And you get to the point where it's real easy to lose sight that trading is hard and everything is probabilistic. And if you've been clicking here the last few days, just constantly reset yourself back to a sense of be picky, be selective, let it come to you, don't force it. And I think that's really important in this type of environment. Bigger picture, I don't want to corner myself into, I mean, there's a lot of moving parts at this point. I think that we're in a multi-day range. I think that we're going to make a lower low, but I'll update that view as we progress. I think that the important positive sign would be, obviously, as I've said, a shift to where if you consider it inevitable that this is going to spread widely, then all that matters for the market is how are we going to deal with that? Are we going to deal with that by kowtowing to a sense that we need to pretend that we're trying to contain it and therefore impose billions of dollars of economic damage? Or are we going to get past that and start to go with a management strategy that also saves all the lives that are lost in an economic downturn? Because as I put this morning, there's 40,000 people die for every 1 percentage point higher in the unemployment rate. So that's probably a lot more people than that are going to die from this virus if we take that strategy. So hopefully we'll get smart about this. And there's my big picture thoughts.
All right, so there you have it. So we'll continue to be tracking this. I will be posting the latest sentiment and flow show to the site in a couple of hours for anyone that might have missed it or missed any of the parts. Obviously, you have the feedback. You have the feedback button to hit as well if you got any questions on anything that Brett and I were talking about here, and we'd be happy to follow up with you. But Brett, as per usual, always enjoy doing this segment. It was a fun time this time around because certainly a little bit more excitement this time for us.
Yeah, it's been great. Okay, thanks, Gav.
All right, talk to you soon.